Imagine an investor whose portfolio moves billions of dollars simply because Wall Street notices a new filing. An investor who doesn't post on social media, rarely gives interviews, yet has built one of the most profitable investment books of the decade. What if the most successful artificial intelligence investor of our time isn't a veteran Wall Street partner or a venture capital legend, but a 24-year-old researcher who was fired from OpenAI just 2 years ago? His name is Leopold Aschenbrenner, and the hedge fund he runs, Situational Awareness LP, has quietly become the talk of institutional trading desks. He is the mastermind behind the AI infrastructure trade, the conviction that the real fortunes of this decade won't be made by software applications, but by the raw electricity, physical data centers, and advanced storage required to make artificial intelligence run. But his latest regulatory filing sent shockwaves through the market when it revealed a massive, multi-billion-dollar bet against the very chip companies that made the AI boom possible. So what is he actually buying? What is he shorting? And what can we learn from his masterclass in macro positioning? Let's break down the data.
To understand his investment strategy, we have to look at how he got here. Born to a family of doctors in Germany, Leopold was a prodigy, graduating valedictorian from Columbia University with a degree in economics and mathematics statistics at just 19 years old. He first entered the public eye as part of the FTX Future Fund, a philanthropic arm of the FTX exchange focused on long-term humanity risks, which he left shortly before the exchange's collapse. From there, he joined OpenAI's Superalignment team, tasked with securing superhuman AI systems. But in April 2024, Leopold was fired from OpenAI over an alleged information leak, a claim he strongly contested. 2 months later, he published a massive 165-page treatise titled Situational Awareness: The Decade Ahead. It was part prophecy, part national security alarm, arguing that artificial general intelligence is highly probable by 2027, requiring trillions of dollars in physical infrastructure and triggering a massive geopolitical arms race. Believing the world was completely unprepared for the sheer scale of the physical requirements, he founded Situational Awareness LP in late 2024 with a modest seed round of $250 million, backed by Silicon Valley heavyweights like Nat Friedman, Daniel Gross, and the Collison brothers. What happened next is unprecedented on Wall Street. By the end of 2025, the fund's reported U.S. equity exposure sat at $5.5 billion. By March 2026, it reached $13.7 billion. And by June 2026, the Wall Street Journal reported that the fund's assets under management had surged past $20 billion, backed by legendary institutional allocators like Jane Street. According to institutional reports, the fund has generated net returns of over 1,000% since inception, and was up roughly 270% in the first 5 months of 2026 alone. Do you think AI investing has already become overcrowded, or are we just scratching the surface? Let me know what you think in the comments below.
When the fund's official SEC Form 13F filing for the first quarter of 2026 dropped, analysts were stunned. It revealed an absolute barbell. On one side, massive, concentrated long positions in physical AI infrastructure. On the other side, a multi-billion-dollar bet against the semiconductor hardware layer. First, let's look at the longs. The fund's largest long position was Bloom Energy, valued at $879 million. Bloom produces solid oxide fuel cells that generate on-site electricity, bypassing the heavily congested utility grids to power data centers immediately. The second largest long was SanDisk, holding $724 million. SanDisk is a pioneer in NAND flash memory, which is experiencing an unprecedented demand shock as AI training clusters require massive, ultra-fast storage pools. The fund also held over $550 million in CoreWeave, the specialized AI cloud provider that has locked up tens of thousands of Nvidia chips. But here is where things become really interesting. To protect this massive long book, Leopold implemented a systematic hedge worth over $8 billion nominal value, consisting of put options, which are options that gain value when a stock price falls. The filing disclosed massive put positions on the VanEck Semiconductor ETF, worth over $2 billion, alongside $1.5 billion in Nvidia puts, $1 billion in Broadcom puts, and nearly $1 billion in AMD puts.
He even replaced a massive call option on Intel with a $159 million put option. Which company from his portfolio do you find most interesting? Is it the energy play or the memory storage thesis? Drop a comment below.
The dramatic scale-up of Situational Awareness LP didn't stop in March. By June 2026, the Wall Street Journal confirmed that the fund's assets had skyrocketed past $20 billion. This rapid capital accumulation was driven by two factors: spectacular performance and massive new capital inflows from major institutional players. Importantly, recent reports indicate that the fund is selectively rotating its exposure. While holding its core energy and storage longs, the fund has been aggressively trading the Bitcoin miner space. Many public Bitcoin miners hold massive, highly coveted contracts for active electrical power grid connections. Leopold's fund fully liquidated positions in Cipher Mining and Hut 8, but aggressively added to CleanSpark, increasing shares by over 600%, alongside increases in Riot Platforms, Bitdeer, and Bitfarms. What unites these companies is not their cryptocurrency mining, but their rapid physical transformation into high-performance computing data centers. Let's analyze the fundamental business cases of the major long holdings in the Situational Awareness portfolio to see if they still present an opportunity for retail investors. First, Bloom Energy. The company specializes in clean, on-site, utility-scale power generation. As tech giants struggle to get approvals from local utilities to plug new data centers into the electric grid, Bloom's fuel cells offer a behind-the-meter solution. The competitive advantage is clear: speed to market. A tech company can wait 5 years for a grid connection or build with Bloom today. The risk, however, is the high cost of natural gas or hydrogen fuel required to run the cells, alongside historically tight operating margins. At current valuations, the market is pricing in aggressive growth, making it a high conviction but volatile play. Second, SanDisk. The NAND flash memory market has historically been a highly cyclical, commodity-like business. However, AI model weights and massive dataset storage require continuous fast access, which spinning hard drives cannot provide. This has turned a cyclical business into a structural growth story. The risk is that flash memory supply can eventually catch up, causing prices to collapse as they have in prior cycles. Finally, the converted Bitcoin miners like IREN and Core Scientific. These companies own the golden goose of the next decade: power contracts and fiber optic lines. Their main competitive advantage is that they already have the permits and the physical substations built. However, converting a facility designed for noisy, basic Bitcoin rigs into a pristine, liquid-cooled facility for $80,000 Nvidia GPUs is incredibly expensive. Which AI stock do you think deserves more attention right now? Is it the under-the-radar power providers or the high-speed memory manufacturers? When a retail investor buys a stock, nothing happens. When Leopold Aschenbrenner's filings are published, the market moves. We have seen clear evidence of this Aschenbrenner effect. Following the disclosure of his positions, stocks like Bloom Energy and various specialized infrastructure plays have seen immediate volume spikes and double-digit price appreciations as retail tracking accounts and institutional copy traders rush to mirror his portfolio. However, we must be highly precise. Is this sustainable, or is it a self-fulfilling prophecy of short-term hype? The evidence suggests that while retail capital can drive sharp, short-term momentum, the long-term price action of these stocks is still governed by their earnings, utility rates, and actual revenue delivery. Leopold is not trading momentum. He is positioning years in advance of the physical bottlenecks. This brings us to a critical warning. Copy trading any major hedge fund manager is incredibly dangerous, and copy trading Leopold Aschenbrenner is especially risky. First, there is the issue of reporting lag. The Form 13F is a retrospective snapshot filed up to 45 days after the end of a quarter. By the time you read about his Nvidia puts or his SanDisk longs, he may have already exited or modified those positions weeks ago. Second, the structural nature of his options positions is highly complex. Those multi-billion-dollar semiconductor puts are not necessarily simple directional bets that Nvidia will go to zero. They are highly calculated risk hedges designed to protect his multi-billion-dollar physical longs. If the semiconductor sector rallies, his puts lose money,
but his private investments and data center equity positions gain value, neutralizing the delta. If you copy his puts without holding his massive, complex long book, you are taking a directional short bet that could easily wipe out your portfolio.
So, what are the ultimate takeaways from the rise of the world's youngest AI hedge fund billionaire? First, look for the physical constraints. When a massive technological wave occurs, don't just look at the shiny consumer applications. Look at the primary inputs that make them possible. If the world is building millions of intelligent agents, who is supplying the electricity, the cooling, and the fast memory? Second, embrace risk management. Even an investor as structurally bullish on artificial general intelligence as Leopold Aschenbrenner uses highly sophisticated multi-billion-dollar hedges to protect his capital from short-term market corrections. If you want to build a resilient portfolio for the decade ahead, look past the headlines. Focus on the physical infrastructure and never forget to manage your downside. If you enjoyed this rational, data-driven analysis, hit the subscribe button. Leave a comment with your thoughts on Leopold's barbell strategy, and we'll see you in the next video.